Hey everyone, DraftKings stock price is up 218% in 2023. Can the momentum continue into 2024? That's the question I'm going to answer in this video here. I'm going to look at the company's latest progress. I'm going to look at a longer term picture of its revenue, profitability, cash flow, etc. And then I'm going to look at its valuation to come to a conclusion whether or not I think investors should buy DraftKings stock for 2024. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So first of all, I like that management is changing focus on growing the business instead of just focusing on growing the number of users on the platform. They're now focused on growing more efficiently. Management said they're focused on acquiring customers efficiently, retaining and monetizing their existing customers through best-in-class product and leading customer service, entering new jurisdictions, and building an efficient and scaled organization. Remember, DraftKings is regulated as a gaming company, so it needs to get approval before it can enter into each new state it wants to enter. Remember, in 2022, DraftKings tried to enter the California market. It put together an initiative along with partners to get an initiative on the ballot for California to legalize mobile gaming, which failed miserably, and DraftKings didn't even get anywhere near close to the support from voters to get itself legalized in California. Nevertheless, DraftKings has had excellent success growing and becoming available in many other states across the United States, and it looks like for the most part it's making good progress on that front. California is an interesting market with many entrenched gaming operators, including the local casinos, the Indian tribes and their casinos, and the horse racing conglomerates, and all the local card rooms, all of which oppose the entrant of DraftKings that could potentially take market share away from them. So there was a lot of spending, counter spending going on. And so the results in California is not indicative of DraftKings results overall in gaining traction, right? The company has grown, and in 2024, it expects to generate revenue between 4.5 and 4.8 billion. That would be about $1 billion increase in revenue year over year, and adjusted EBITDA of around 350 to 450 million. Now that the company is growing and has reached a certain scale, the profitability metrics are improving. It's making progress on that front. In the third quarter specifically, they increased revenue by 57%, and they achieved the number one combined online sportsbook and iGaming market share in the United States. They are the number one market share gaming company in the United States. Now remember, with online gaming, the benefit is that they don't need to pay to operate those expensive brick and mortar casinos, right? They don't need to have the hotels, the staff, the maintenance, all of that. That's an expense that they don't have to undertake compared to their rivals, gaming companies that do have to have that. So potential profitability is higher for a mobile gaming company compared to a physical brick and mortar casino. That being said, it's going to be difficult for DraftKings to retain market share. Right now, it's got the number one market share. Doesn't need to be the case next year, the year after that. Customers for online gaming, they can just go to another platform. They just download a different app, right? And competition could increase. Right now, it's slowing down as other players are also saying that they prefer to grow efficiently. And so the spending on marketing is not as aggressive as it was earlier in the growth phases of these businesses. Remember, they can offer a deposit bonus. Sign up and get $500 to deposit in DraftKings if you deposit 500, so a matching bonus, right? And then after DraftKings does that, their rival could do that, so customers can switch from one app to the other, just taking advantage of those bonus offers that are frequently available, right? This reminds me about 2 decades ago when online poker was a big thing in the United States, and there was several apps, and that's what there was, a lot of bonuses being offered by all of these apps. And so customers would just switch around to the companies that were offering the bonus. So they would deposit $100 here to take the $100 bonus. Then after they were done with that bonus, they would go to the other one and take the bonus. There wasn't the stickiness that is requisite for companies to retain market share. There's low cost of switching, if I could put it in more technical business terms. The cost of switching is low. It's not much of a hassle to switch to another provider. So those are a couple of things to keep in mind with DraftKings longer term. Nevertheless, the company has made excellent progress, and you could see here average monthly unique players in the millions increased from 1.6 million to 2.3 million in the quarter ended September 30th. But not only that, the average revenue per user increased by 14% to $114, up from $100. So they're growing the number of users, and they're getting each user to engage with the platform more often and spend more money. And that's been good news for DraftKings stock. Longer term, you could see this phenomenal revenue growth from less than 100 million in 2019 up to 789 million in the most recent quarter. As the company gets access to more and more states, there's still a long way to go. They're available in about half of the states in the US, less than half, I would say, and they're growing and growing and growing. And so as they keep penetrating new markets, their revenue is likely to continue rising upward. And as the company has been increasing its revenue, it's been demonstrating growth in profitability. DraftKings is demonstrating economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from $100 in year 1 to $115.76 in year 4. While net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. That being said, let's look at DraftKings and how it's improved from an operating profit margin close to negative 160% all the way up to negative 29%. The company not likely to be profitable on the bottom line in 2024, but it wouldn't surprise me if they started to approach profitability in 2025. Similar story with cash flow from operations. You can see it dipping downward and then the company hitting an inflection point and starting to make progress on this front. And the progress has been rapid. If it continues on this pace, it won't be long before the company starts generating cash flow from operations. And interestingly, I mentioned the promotion incentive spending. That is most focused in the beginning stages when it gets entry into a new market. Let's say California gets legalized in 2025, right? DraftKings would spend a lot of money up front, letting the state know, letting the population of the state know that they are now available, and offering bonus and customer acquisition spending to get people to download the DraftKings app and make a deposit. But then after they get that initial wave of customers, that promotional activity is reduced significantly. At least that's what's happened with DraftKings in each of the other states that it's entered. A big blitz up front with the spending, and then once it acquires the customers, gets people to download the app, it slows down that spending. So it's not a recurring expense. That is a that is a problem for DraftKings. Remember, I mentioned earlier the foundation, the structure of the business, the lack of spending for infrastructure and maintenance and operating a physical casino means that the business could be lucrative longer term once it reaches that scale and all of that initial upfront spending is behind it. And we're seeing evidence of that already with DraftKings. And finally, I wanted to look at the valuation, and DraftKings is trading at a forward price to sales of 3.641, which in my opinion is expensive. Now let me explain why. DraftKings, I'm mentioning it's making good progress, gaining traction with the market, right? And it's growing rapidly right now as it's adding new states. One of my issues with DraftKings, in addition to the lack of stickiness with the customers, the customer switching costs are low. The other issue I have is in the total addressable market. Estimates suggest that the mobile gaming business in the US at maturity is going to be at about $30 billion. And DraftKings expects to generate about 1/3 market share, so about $10 billion in revenue at its peak annually for DraftKings. Now that's at the peak. And so for me, paying this kind of valuation for a company that at the peak is going to generate 10 billion in revenue and roughly 30% margin, so 3 billion in profitability, is a little bit too rich for me, with considering all the risks also for the company to actually achieve that target, right? So the target, the end goal, the possibility is not that high, and then even the risks of reaching that is already elevated as well. So for now, I'm not recommending DraftKings stock as a buy for 2024, but I wouldn't be surprised if the company makes really strong progress during the year if I perhaps change my recommendation, or if the valuation perhaps decreases and investors are able to buy the stock at a more attractive valuation. I could then recommend DraftKings stock as a buy. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.